Joining us this morning, Citi Research Director of U.S. Equity Strategy, Drew Pettit's with us. Drew, welcome back. Good to see you.
Hey, good to see you, Carl.
I got to say, making your way through September with no major hiccups on the headline indexes kind of has the desks today saying maybe we averted weak seasonality and we can look forward to an up Q4. What do you think?
Yeah, it's funny. It's going to be very dependent on the earnings season. To us, the pressure's actually grown with a pretty good September. So the pressure on fundamentals to deliver, to be exact here. So look, Q3 reports aren't going to be about who posts good numbers, but it's going to be a lot about the commentary. Not about the commentary in Q4. It's going to be about 2026 and some of the structural opportunities. So yeah, it might feel better from a seasonality perspective, but from a fundamental perspective, you need beat and raise to sustain this bull market.
Are you confident that's what we'll get? I mean, there's been no lack of chatter about maybe $300 in earnings once we work our way through the season.
Yeah, I think it's possible. I think the big point here is going to be on productivity and margins. I think margin expansion into next year is almost a given because of OBBBA, but the productivity side, some of the other measures like total asset turnover and efficiency needs to be really high for these companies. I think if we push ROE to new highs, you can sustain higher than average valuations. From here, then earnings kind of drives the boat. You get a healthier kind of leg of the bull market, not just speculation led.
Yeah, we were talking earlier about that CSX and what cyclical stocks are telling us right now about the direction of travel for the U.S. economy and earnings growth, and the outperformance is notable.
Yeah, I think that's the beauty of it. Under the surface, there's a lot of ways to get to 10, 12% earnings growth. You either have a whole bunch of companies that are growing at 20% and then a chunk on the other side growing nothing. When you look at 2026, you're going to get a convergence, where there's more companies that are going to be contributing to positive earnings growth. Then you get broadening of markets, broadening of participation, and healthy upside, not just a narrowly led market from here.
You do, I think, upgrade a bit consumer discretionary, right?
Yeah, it's, again, where the cyclical might kick in, or at least there's nothing priced in expectations-wise on the consumer front, right? So if we get some tailwinds from lower rates in some of the more rate-sensitive areas, yeah, that part of the cyclical can really kick in. You know, you pair that really nicely with the financial story that's playing out well and credit's holding in with the secular tech story, and you get this nice little barbell you can have in portfolios where you add growth and cyclical beta, and it's a great way to potentially position yourself for broadening.
Does the broadening include small caps, which have rested more on the Fed rate cut hopes? So if we are seeing a cyclical upturn, then maybe we don't need as many rate cuts.
Yeah, I'd agree with that. It's funny. We kind of argue that the Fed might not matter as much if the underlying economy holds in better than you think. But yeah, it's definitely a tailwind if you're getting both, and small cap definitely benefits. It's funny, if we're going to step back, more of a 1,000-mile view here looking down, you probably want to buy the NASDAQ on one side and pair it with the Russell 2000 and small cap on the other. What you really might want to kind of overlook is a little bit of large cap value. Use that as your funding for that barbell trade.
Interesting. Finally, credit spreads getting lots of attention today. Page one of the Journal looking at just how hot credit is running. Got to go back to the 90s on some of these things. We have had some blow-ups in auto subprime financing. How do you think about all of that?
If you have a constructive macro backdrop, if you don't have a lot of commodity volatility, not a lot of rate volatility, not a lot of FX volatility, which is the backdrop right now, that's good for risk assets. We see that in equities. We think credit's reflecting that.